Tim Doggy,
I thought it was just you.
There we go. Perfect, comes to mind.
Okay, it's rolling.
Okay, we are back in session. It is 10:57 on February the 7th, 2017. We are honored to have our treasurer and our representative from firm
Meter Investment.
Meter Investment to talk about the current state of our investment portfolio for the county. Mr. Treasurer, Mr. Alt, would you like to begin?
I would just probably turn over the presentation to the our investment advisor, Eileen Stanek with Meter Investments. Just for the record, Eileen is certified for government entities. That's who she performs investment advisory services for, because it's a unique niche market.
Okay, Eileen, you're on.
Great, well, thank you, I really appreciate it. It's a pleasure to meet you, Commissioner Stacy. Nice to see you, Commissioner Kirschner. Yeah, as Damon had mentioned, our firm works predominantly with public entities. I've been working with public entities for over a decade. Meter Investment, we're out of the Columbus area. I maintain an office here in Northeast Ohio. We've been working with public entities, as I said, for pretty much the tenure of the firm. We work with the State Treasurer's Office, in addition to over 20 counties in Ohio, and the total client base is in excess of 150 Ohio public entities, which includes schools, counties, cities, and the like. So I'm certainly honored to help the county here with the investment process, because as Damon had mentioned, this is a very specialized field where we are constrained by Ohio Revised Code, which limits the investments that the county can embark in. So that being said, if we want to just jump into the presentation here, starting out with page 2, we have the executive summary. So it just kind of summarizes really what is going on in the markets, and then additionally what is happening with the county's portfolio. And we've certainly, as we've come out of the presidential election, have had a bit of a sea change in the market environments. Market is anticipating a much better economic environment for the U.S., and that has fed into a little bit of a bump in interest rates. So as we have this move towards fiscal expansion, helping the U.S. economy, and the economy not being totally reliant just on monetary expansion, which is the environment we have been in coming out of the recession. Inflation expectations have started to increase as the market is anticipating, number one, the potential for some increases in wages as a result of an improved jobs environment, as a result of perhaps infrastructure projects which may come on board with the new administration, and then additionally the opportunity perhaps with the trade agreements being renegotiated that may result in some inflation on the import side as well. Of course, the low interest rates abroad continue to exert downward pressure on our environment even as we speak. Just looking at some of the news this morning, Greece is back in the picture again with negotiations ongoing with their bailout, and then we now have France with the election as well going to take place, and depending on who is elected there, there's discussion as far as perhaps exiting the European Union, just as Great Britain did. So certainly there's a lot of other factors outside of the U.S. that are also impacting our markets, in addition to the positive factors here. The county has 3 investment portfolios. We have what we refer to as the general fund. We in addition then have the engineers maintenance reserve fund, and then the funds associated with the Joint Justice Center bond issue. So as we can see when we look at the first table, the general fund and the engineer fund are for the most part fully invested. Very small balance in the money market fund. Most of the funds are in securities. And the Joint Justice Center, we're continuing to work on investing some of those funds. Just recently opened up a Star Ohio account, which is a fund that is administered by the state and managed by the state treasurer's office, which we serve as co-advisor. So it provides some liquidity, which will be very important to have some of those funds available as this construction project is underway and the bills will start to come in. Looking at the bottom table,
Let me ask you one question about the
Yes.
bottom. We got the duration and the weighted average maturities, et cetera. How does this compare to portfolios that you manage from a duration standpoint?
this is very much in line because, our clients are all subject to many of the same constraints that you
Sure.
are. So we take the approach, particularly in the case as it relates to the county, these are excess funds, so we're not, other than the Joint Justice Center, that these are excess funds that are not needed for liquidity purposes. So we're able to administer a very common investment approach. So whether we're working with you, with Damon, or whether we're working with another county, say like Lake County, who would have a very similar situation.
Okay, so what's the procedure? We have an agency that matures, and it's how much a block? You're buying in blocks of $500,000.
Well, we're able to go into
Typically.
the marketplace because we're managing over $2 billion
Sure.
total with public entities. So we may have, 20 clients that have a maturity at the same point. And so we're going into the marketplace to purchase a much larger block, of which then
Right.
a portion is allocated to Seneca based, as
We
you
have
said,
a
on
limit
maturities.
to the one security that we can be involved in, an agency, or we have a maximum that we can have of a certain Fannie Mae or
It
mortgage
could
backed.
be, was it like 25% of total holdings?
Just revise the policy. I know we have
Yeah.
that built into our compliance system. I did not bring that with me. But we do have limitations as far as.
Okay, so we have
making-
500,000 roll off.
Right, and so
We
we,
gotta
would-
replace 500,000.
Mhm.
What's the procedure?
the procedure would be in advance of the 500,000 rolling off, we determine what the strategy is.
Okay.
So in this environment, we're looking to extend the duration because interest rates have moved up. We feel that the market is
Sure.
a little bit ahead of itself. So at that point, then we determined that we would be looking for a longer term
Something
security.
okay.
So at
So
that
you
point.
consult with Damon about what your recommendations are,
Yes,
And
from
he
a
says-
strategy standpoint, not an individual security
not in
standpoint.
individual securities.
Right,
Okay.
but on a strategy standpoint.
And then you determine whether you're gonna buy a CD or whether you're gonna buy an agency, or what other types of securities can you buy?
In the longer term market, we could look at municipal securities, of course, unless we're looking at a taxable municipal
Right.
security, that's not going to offer the best
But there are some
yield.
taxable municipals, but.
There are some.
What is the riskiest, if I may ask?
The riskiest would be a corporate bond.
So you can buy some corporate
We
bonds?
can buy some corporate bonds, but we are limited under Ohio Revised Code to a maximum maturity of 2 years.
Okay.
And 15%
And I
of the
assume somebody in your
investment
office does
portfolio.
the due diligence and the adjudication
Yes.
on that?
Yes, that's one of the things that separates us from other advisors. We perform independent credit research on issuers for corporate bonds and commercial paper as
Mhm.
well. So that's above and beyond the
So what
credit
do-
rating limitations.
Do we have set in our investment policy, and I'm sorry, I should know this, maximum duration for the portfolio?
Yes, 5
That-
years.
5 years, okay, so we are 2/5 of that, 20% of that at this
Right.
point in time,
Yeah.
right? And what range do you feel comfortable given the increase in rates right now?
We would feel comfortable extending such with the duration of about 2.5 years.
Okay, so you want to get us in more of an asset-sensitive position?
Yes, exactly.
Okay,
Because keeping in mind that, right, the market value of the securities is gonna change with time. What we do hold to maturity, we do periodically or on an ongoing basis assess whether there are opportunities to sell.
so you list them as
something.
hold to maturity,
Mm-hmm.
you list them as available for sale, and you list them as a trading account? Is those are the three options, or that's just banks?
That's just banks,
Okay.
banks and corporations,
Okay,
right?
so you can
Subject to
show them as
FASB.
hold to maturity?
Yes.
Or what?
Everything
avail-
is just held to maturity.
Everything is held to maturity,
Right.
so there's no write?
No.
Or there's no write down or write up of the
No.
portfolio then, based
Right.
on what happens, okay?
That's exactly right.
think
There's a
so.
reporting requirement in the footnote disclosures for the financial
Well, I mean,
statement, but
right, it
there's
does make a
nothing that
difference,
can
it
pass.
does make a difference in how you deal with the
Yes.
portfolio, given that. I mean, obviously, I look at it with a different type of eye.
Right.
Okay, so, do we really think that now is the time to extend, or should we wait a little bit longer? I mean, the prediction is that we're gonna get 2 more probably 2 or 3 more bumps here in the, from FOMC. Okay?
Well, if we want to kind of flip through a couple pages here, I have
Okay.
something to address that, right, which has been that
Let's see,
the
Open
Fed.
Market Committee, Holly, which is that group that adjusts the interest rates.
Right, they adjust
Bank
the
rates.
short-term interest rates.
Right.
And that would be the Federal Open Market Committee, which is,
Consortium of, you know,
Yeah,
Federal Reserve
Federal Reserve.
presidents, yeah.
exactly. So we have a chart in here. Hold on, bear with me.
You have a
a minute.
statement, you're talking, looking for statement highlights from the FOMC, is that what you're looking for?
No,
Oh.
I'm looking for, you have an interest rate
But
out
I
there,
guess
page-
my only point
Oh,
is
page
I.
9.
Okay.
Yes, page
My
9.
my only point is, I appreciate the fact that you wanna go longer, because I think
Yes.
that makes sense right now.
Yeah.
But I wouldn't be in too big a hurry to go longer.
Right, and we're not, we're being very patient. That is one thing that we incorporate not only into our strategy, kind of a long-term outlook, but additionally, kind of a short-term outlook. When does it make sense to buy the longer securities? Does it make sense to do it just because we have a maturity? Well, that may not be the right time to do it, so therefore, we may take our time in finding the right spot. So we have are very much a quantitative organization in that we're looking at things like momentum, we're looking at valuations, we're looking at kind of some of those technical indicators in addition to the fundamental indicators. But if we look at page 9, this is where we're looking at the swaps market. And Mike, this may be something you're a little familiar with
Yeah.
from your banking days. And what the swaps market is telling us is really what is the market anticipating that the Fed will do. So again, this is looking at the market's expectation, their outlook for the movement in the overnight interest rates. And if we even look out, just look out 2 years, we can see that prior to the election, the market was anticipating really maybe one interest rate hike before then. We look at now at the blue line post-election, and we can see that the market is pricing in that maybe the overnight rates will be between a 1 to 1.25% range. So again, right, the Fed has come out and said, well, we forecast that we potentially could do 3 rate hikes in 2017. But again, it's going to be very dependent on the data. You know, the Fed has been very patient in moving off of those 0 interest rates. And the market, of course, looks at a broader set of data and is expecting that the Fed will truly be very patient, that the market data is such that this will be a slow movement in
Okay.
interest
Well,
rates.
it looks to me like we have in the range of about $5 million maturing
Yes,
in 2017.
yes,
So, and I know that you guys have analysts, and I know those guys
Right.
put a lot of pencils to it, but my suggestion at least would be maybe that stuff that matures in the near term, that we park it a little bit, and then I look for the better yields maybe in the second half of the year.
well,
I think that we would be much better served, but that's my opinion.
yeah, and if you're looking at page 13, right, which gives the bar charts of the maturities of the general portfolio,
Yeah,
you know, we can see that as of 12/31, we had 10% of the portfolio was out in the 5-year area, 18% out in that 4-year area. We're looking to move that 5-year allocation upwards of to about 19%. So, you know, kind of addressing your point, we're not looking to put a significant amount in that 5-year area when we're looking to keep about 40% in that 1-year space. So
Well,
again,
it
a
just
little bit
wouldn't bother me,
more of a
yeah.
barbell.
I mean, I would from a personal standpoint, I would sacrifice some yield in 2017 for the probably much bigger yields that are gonna be out there. I don't wanna chase yields, but
Right.
on the same token, if we are pretty certain, if the odds are better than 50-50, that, you know, we're gonna get 75 basis points in 2017, that wisdom would tell me that we maybe ought to wait to invest it longer term until a couple of those happen anyway. So that's just, I mean, and then better wisdom probably would do half of it now and hold half of it.
Right, and that's where our thoughts is that we ease into this. We had certainly pulled back and shortened up the portfolios last year when the market opportunities were such that
Sure.
we felt it did not make sense. But now that the market has moved back, we are starting to step back into the longer maturities because, again, while the Fed may raise interest rates in the short term, the longer term rates are going to be more driven by other factors that the Fed can't really control, i.e. what
Right.
happens with the U.S. economy. Are the infrastructure projects going to take 2 years to get underway? Will the tax reform take longer than the market is anticipating? The healthcare reform, we know now that that's, maybe getting pushed back. The trade negotiations, what's going on, in Europe. There's a lot of factors there. And so, right, we're looking at that whole picture and feeling comfortable it makes sense to start to step back into that longer term area. But just as you said, not go full board.
And even though it doesn't affect the balance sheet,
Right.
it's better to have a warm fuzzy that there might be a little bit of a gain in the portfolio as opposed to not. As you know, as rates go up,
Right.
that loss is gonna continue to increase significantly.
Absolutely, right.
Yeah.
Yeah, right, the market value of the securities will
Right.
drop, there is no question. But again, we do have that ability that we do hold to maturity.
Sure.
So those, are negated by the time we get our par back.
And the only last thing that I'll say about that, it's probably not the last thing, but the only other thing that I would suggest is that somebody look, I see there's a little bit of you have a little bit of corporate in there, but we ought to
Yes.
look real strongly at some of those taxable municipals.
Yeah.
Because those are starting to really bump up in rates, and
Right.
as you know, that again, they're typically
Right.
10 or 15% higher than the agencies, so.
Right, we do have, do assess those as well. One of the elements to our whole process is what we call relative value. So looking at, what does, a treasury security yield versus what does an
Right.
agency yield versus a callable agency versus if we're looking in the short term, commercial paper versus the corporate bonds, and then additionally the taxable municipals as well. So yeah, absolutely, as particularly the municipal market has started to move up, I would also expect that the issuance on the taxable municipal side may increase. Again, we want to make sure that when we're buying a taxable municipal piece, that we're not getting into kind of maybe a conduit bond, something that's, kind of not a direct obligation, maybe is backed by, parking garage revenue,
Yeah, that's
something like that. So
I mean,
again,
you wanna get GOs,
making
and maybe,
sure,
there's some that are actually
Right.
having, again, as you know, some that
Yeah.
actually are insured.
right,
On top, they're GOs and
Right.
they are insured, so,
Right.
those are, you're gonna get a little bit less yield, as you know.
right,
But at least it's different for the portfolio.
Right.
And we do have some real room here to lengthen that duration.
yes, we do. Yeah, and the portfolio, is diversified, certainly we, by having added in the corporate bonds, we've assessed the opportunities. As I said, continually, when we found that there was relative value to buy, invest in a corporate bond, we acted upon that. We identified when the commercial paper market presented some opportunities, particularly in view of the money market reform, which took place in 2016. That presented very nice opportunities on the short end, which was a nice complement to the fact that the longer end had fallen away, so we were able
Sure.
to switch over into the shorter term securities as well.
Well, Dave, another reason to be able to certify more money, actually, I think we probably ought to get a 0.5% bump in the average yield in the portfolio this year, which, with the amount of money we have, it's $100,000. That's another reason to say, a good reason to say that we're gonna generate more income.
Yeah.
Yeah, certainly when we look at the yield on the portfolio, as of the end of 2016, at the 142, that's up from where we were at the end
Sure.
of September.
And I bet it'll be touching 2 by the end of the year.
We would hope so. That will happen. At this stage, the market is certainly, we think in terms of the short end,
Sure.
thinking, maybe June, maybe mid-year, we might see a movement, but, we've got several months going there, more likely in the latter second half of 2017. The key will be what happens on kind of that longer term as well. We're only, when we think in terms of absolute rates, the earliest that we're seeing a 2% is around the 4-year area.
Mhm.
So when we think in terms of, can the total portfolio get
Right,
there?
but
We've got to get that 2%
Sure.
available in 3 years, 2 years, and shorter,
Yeah. And I
in
think
order
you'll see
to
that.
really
I
get the
think you'll see
portfolio
that.
to move to that direction. It'll take time.
I have a question for
Yes.
Eileen, based on that. Now, with some of the changes that I just domestically hear, like NAFTA, they're proposing,
Mm-hmm.
and you might get into some trade wars with the Asia Pacific countries. If that does in fact trigger maybe some inflationary
Mhm.
issues, because whether it's a tax on incoming exports, whatever it may be,
Mhm.
what's the Fed's response gonna be? Raise interest rates right away? Are we gonna see like a short-term spike? Or is there anything
Yeah.
out there, any information out there on that? I mean, I don't see it, but I'm
Right.
not tied into the same
Right,
databases, and that's the one thing I was kind of wondering about. We had not talked
right,
before about that, and I keep seeing that kind of on the burner with
right.
the trade issues.
Yeah, that's where, we have, again, another chart in here, page 8, which is the inflation outlook, which looks at the 5-year break-even rates. So what that's looking at, Damon, is the difference between the US Treasury fixed coupon securities and the US Treasury inflation-protected securities. So it looks at that differential. That's a market measure of inflation expectations. And we can see that post-election, it did start to increase. So as, this is again going to be something the Fed also is going to be looking at, and the market looks at as well, to determine really how quickly should the Fed move. As we know, the Fed has a mandate of 2% inflation target. They have pretty much said, from an expectation standpoint, they would be okay with the expectations being between that 2 and 2.5%. So we're not there yet, but
No.
right, if those renegotiations really start to come to fruition and we really do start to see these indexes like this move up, then certainly that would provide a basis for the Fed to want to move a little faster than what the market is anticipating today, and that would also have exert pressure on our longer-term interest rates and serve to push them up higher. Unfortunately, we're in a global economy, global financial system, I should say, irrespective, and anytime our longer-term interest rates go up, we get monies overseas, global investors investing in our markets, we have more demand, and that serves to temper factors like this, which would historically have had a very direct impact on the movement of interest rates.
Everything we have is fixed rate to maturity.
Yes.
Do we ever consider any variable rate purchases?
We have purchased what is referred to as a stepped coupon. We did that last year. There was, again, when the 5-year securities, those opportunities had passed, we were able to negotiate with the agencies to structure a stepped coupon security that provided us 6 months at 0.75, and then the coupon rate stepped up for the remainder of the term.
To some index and to some spreads with index?
We're under Ohio Revised Code, we're limited on variable rate securities. So anything like a LIBOR floater, can't do a LIBOR floater. Agency security can only do agency securities that have as an underlying index US Treasuries. And this
Okay.
is the law, and subject to a 2-year maximum maturity. Yeah. So it's a sector, again, going back to that whole relative value standpoint. From a relative value standpoint, do we think it makes sense to be in a short-term floating rate instrument, or when we have as an alternative, say, commercial paper, which for 9 months provides us with a yield of anywhere from a 130 to a 160.
Okay.
Anything else?
No, good job. Good.
Thank you.
Good explanation.
Thank you.
Thank you, appreciate it. Love the
So-
dialogue.
Well, yeah, Mike's probably better versed in this than I am from the banking side.
It's got
Accounting
the-
doesn't look at it from that standpoint. Market or hold to maturity.
Well,
I mean,
yes.
we don't look forward. We look
Yeah.
back. I mean, that's the way you're trained.
Yeah.
But I do, just for clarification on the federal rates, Are they projecting a bump in June?
The market is, has about a 50/50
Oh.
likelihood. That
Well,
means
I
June, we
mean-
may see something.
Because
Virtually every time they think there's gonna be an increase, it's
Yes.
baked in before it happens.
Yes,
So when the increase actually happens, you don't get the 1/4% bump.
right,
it's already
You get
factored
maybe
in.
10 basis points, because they're already baked in 15.
Yeah,
exactly.
So,
Mm-hmm.
you know, it's,
I guess I just go back to like '09. We spent what, 2-3 years with no interest rate
well, all the
hikes after
consensus, if you
basically.
read all the consensus economists,
Yeah.
and, you
It
know,
is.
they invented economists to make astrologers look good, but all the consensus economists say that there will be 3/4%, if you take the consensus,
Mhm.
325 basis points increases in 2017. Now, we'll see.
Right.
But there could be a 50 if something crazy happens, or there could be a skip because they want to settle in and see what happens. So,
Right.
but the consensus is, there's some guys out there saying 2%, and there's some people out there saying flat. So
Yeah.
who knows?
So we'll be somewhere in between,
Yeah.
in that range,
Yeah.
yeah. And absolutely, right, there's, it's all very data-driven, so, and, you know, I think as we, of course, saw last year, in 2016, the Fed had, at the end of 2015, had indicated that we may see 4 rate hikes. Well, that all sounded well and good, but as we know, U.S. economy didn't really take off. We had issues with China, and we had the Brexit vote, and then we got into the election season.
And you can bet your butt that something else crazy is gonna happen this year, so
Exactly.
who knows? Well, I appreciate it. My
Thank you.
limited knowledge tells me you're doing a pretty good job with the portfolio, so I appreciate
Thank you.
it.
Appreciate it. Any other questions? concerns?
Appreciate the information.
Well, thank you.
Try to absorb as much as possible.
Okay, 11:25, we are adjourned.